Do you want to learn about ICT mitigation block in depth? Well, in this video, we will teach you everything about ICT mitigation block from its formation to its identification and to its use with real market examples. After watching this video to the end and practicing thoroughly in the market, you will gain the ability to identify and trade ICT mitigation block like a professional trader. In this video, you'll learn about what the ICT mitigation block is, its types, and why it's important to traders. How to identify the mitigation block. How to trade the mitigation block. A difference between breaker and mitigation blocks. Now, let's begin with defining the ICT mitigation block. ICT mitigation block is a reversal pattern indicated by a failure of market to swing higher or lower in bullish or bearish market respectively at a strong institutional reference point like order block, breaker block, or imbalance. Mitigation concept basically means selling short-term rallies in bearish trend and buying short-term declines in bullish trend. A mitigation block in forex trading refers to a specific order on a chart that indicates where previous movements have stalled and reversed, marking it as a potential area for future market turns. This concept within the smart money framework is crucial for traders looking to manage their positions by taking advantage of strategic entry and exit points. The idea behind these areas is rooted in the dynamics of supply and demand within forex. When a currency pair reaches a level where buyers or sellers have previously entered the market in force, causing a reversal, it suggests a potential repeat of such actions when the price returns to the area. To identify and trade an ICT mitigation block, we will be dividing it into two types: bearish mitigation block, bullish mitigation block. Bearish ICT mitigation block. This type forms during an uptrend and is identified by a significant peak followed by a decline and a failed attempt to reach or surpass the previous high, creating a lower high. When prices drop below the previous low, the order block above the low becomes mitigation. It may be characterized by an increase in selling volume as the price approaches the level, signaling resistance and a potential downward reversal. Bearish ICT mitigation block forms at the end of a bullish trend when price reaches a strong bearish institutional reference point like bearish order block or breaker block, or a higher time frame buy-side liquidity is taken. When price reaches bearish institutional reference point or takes higher time frame buy-side liquidity, and then instead of making a new higher high, it makes a lower high. After making a lower high, price declines and breaks the previous higher low, resulting in market structure shift to the downside. So this state of price delivery is called failure of price to swing higher. Now, the area from the swing low broken, indicated by point A in the picture, to the lower swing high formed, indicated by point B in the picture, is termed as bearish mitigation block. The concept behind it is that the price was bullish initially and the traders were buying the bullish rally, but price failed to swing higher and shifted the structure to downside. Now the traders who bought in the bullish rally from point A to B will mitigate their losses when price approaches that bullish rally. And the smart money will look to sell from that area of mitigation because of the bearish institutional bias. Now every time when price breaks below the previous low after a short-term bullish rally, it will create a mitigation block, and you can anticipate selling from that ICT mitigation block. Bullish ICT mitigation block. Conversely, a bullish type is established during a downtrend. It is characterized by a significant trough, followed by a rise to form a higher low and a failure to drop below the previous low. As the pair moves up, the order block below the high marks mitigation one. This area often shows an increase in buying volume as the price approaches, indicating support and a potential upward reversal. Bullish ICT mitigation block forms at the end of a bearish trend when price reaches a strong bullish institutional reference point like bullish order block or breaker block, or a higher time frame sell side liquidity is taken. When price reaches bullish institutional reference point or takes higher time frame sell side liquidity, and then instead of making a new lower low, it posts a higher low. after making a higher low price rises and breaks the previous lower high, resulting in market structure shift to the upside. So this state of price delivery is called failure of price to swing lower. Now the area from the swing high broken, indicated by point A in the picture, to the higher swing low formed, indicated by point B in the picture, is termed as bullish mitigation block. The concept behind it is that the price was bearish initially and the traders were selling the bearish rally, but price failed to swing lower and shifted the structure to the upside. Now the traders who sold in the bearish rally from point A to B will mitigate their losses when price approaches that bearish rally. And the smart money will look to buy from that area of mitigation because of the bullish institutional bias. Now every time when price breaks above the previous high after a short-term bearish rally, it will create a mitigation block, and you can anticipate buying from that ICT mitigation block. What makes the mitigation block important in trading? Mitigation blocks are crucial for traders because they offer valuable insights into potential market reversals. Here's why. 1. Identifying potential reversal zones. They pinpoint areas where the market has previously shown signs of weakness or strength, suggesting a potential change in direction. For instance, when a bearish mitigation block forms, it is expected to become a supply zone from which the price can continue downwards. The same can be said for the bullish mitigation block, which will become a demand zone from which you may expect a further rally to the upside. 2. Improving entry and exit points. Mitigation blocks serve as great entry and exit points for your trade. This is one of the more popular uses of these blocks. After the block forms, it is common to find traders placing limit orders at those blocks. Also, traders who are already in a position see the mitigation blocks on the opposing side of their trades as potential exit levels. 3. Risk management. Traders who enter trades at mitigation blocks tend to place their stop losses on the other side of the block. For instance, you can enter a bearish trade as soon as the price touches the bottom of the mitigation block and place your stop loss just above the same block. 4. Confirmation of market sentiment. Mitigation blocks can reinforce your view of market sentiment when combined with other technical factors. This way, you get a clearer picture of what the market is trying to do. How do you identify a mitigation block? Identifying the mitigation block is relatively easy. Let's show you how. 1. Higher time frame point of interest. The first step in identifying a mitigation block is to identify a point of interest on a higher time frame. This point of interest could be an order block, fair value gap, rejection block, or any important level where you may expect a reversal. This higher time frame point of interest adds confluence to your mitigation block. If, for instance, you expect the market to reverse to the bearish side after reaching a daily order block, you go to the 15-minute chart, and indeed, a market structure shift has happened after creating a mitigation block. Without this higher time frame point of interest, your mitigation blocks risk being false. 2. Wait for a reversal. After the price reaches your higher time frame level, go to a lower time frame to scout signs of reversal. And this is where you'll often find your mitigation block. Note the order for a bearish mitigation block. You want to see a new higher low after your most recent high, your higher high, that this higher low must fail to create a new higher high. The price will then fall to break this previous low, leaving a new lower high behind. The last significant down close candle on the higher low is your mitigation block. And for the bullish mitigation block, here's the order. After the most recent low, the lower low, you want the price to rise and create a new lower high. This lower high must fail to create a new lower low. The price must then rise to break the lower high, leaving a higher low behind. The last significant up-close candle on the lower high is your mitigation block. How do you draw the mitigation block on your chart? There are two main ways of drawing the mitigation block on your chart. How you choose to draw yours will depend on your trading style. The first is to use the last significant down close candle before the push that creates the lower high for a bearish mitigation block. or the last significant up-close candle before the creation of the higher low for a bullish mitigation block. The second method of drawing your mitigation blocks is to mark the entire leg leading to the lower high in a bullish scenario or the entire leg leading to a higher low in a bearish scenario. The first one is more precise than the other, giving you a better reward for your risk. On the flip side, it's possible that the price does not get to the order block before reversing. The second method is not as precise and won't give you the reward for the risk the first offers, but it will help you catch the most trades. How do you trade mitigation block? This section will show you how to use the mitigation block in your trading. 1. Locate a higher time frame point of interest. Your first task is to locate a higher time frame point of interest. The point of interest could be an order block and fair value gap, an optimal trade entry, or any other point where the price is likely to reverse. Also, your higher time frame could be any time frame higher than the one you intend to take your trade entry on. In our example, we'll be using the 15-minute time frame as our higher time frame and the 2-minute chart as our entry time frame. Here on the chart, we've marked out our higher time frame point of interest, a bearish fair value gap. 2. Identify your mitigation block. Dip into your lower time frame and wait for the formation of the mitigation block. Don't forget that it's the block that fails to break structure in the direction of the current trend before a market structure shift. In our chart, for instance, notice that our higher low does not lead to a higher high. Instead, it creates a lower high before breaking that higher low. We then mark out the mitigation block using the last significant down close candle before the failed rally up. 3. Place your entry at the mitigation block. There are various ways to go about your trade entry. The aggressive approach is to place limit orders as soon as the mitigation block forms. If you're scouting a bearish mitigation block, for instance, place your sell limit order at the bottom of your mitigation block. If you're looking at a bullish mitigation block, place your buy limit order at the top of your mitigation block. The idea behind this is that the block tends to reverse the trend. So, by placing our orders there, we can catch the reversal just as it happens. However, we run the risk of the block being cleared out as though it weren't there. The conservative approach is to wait for some candlestick formation that confirms that the market is truly about to reverse, even after we get to the mitigation block. In our trade example, for instance, we wait for signs of a bearish move inside the mitigation block. We see a strong displacement to the downside, leaving a fair value gap behind. It is at that fair value gap that we place our limit order. 4. Manage your risk. What's next is to place your stop loss on the other side of your mitigation block. Some traders place it just on the other end of the mitigation block. This method is more aggressive. You'll also find some traders placing it above the most recent swing high or low on the chart, which is more conservative. And as for your profit target, you can be more flexible with this. You can place it at the next significant low or the next order block or fair value gap in the direction of your trade. If you're very ambitious, you can also look for the next swing point on the higher time frame and place your profit target there. This method guarantees the highest risk to reward in most cases. However, it is just as risky. In our trade example, we'll place our stop loss just above the mitigation block and our profit target at the next significant low. Tips on marking out high probability ICT mitigation blocks. Not all mitigation blocks are likely to hold and reverse the price. If you've been on the chart long enough, you'll find that many are just traps in waiting. So, these are tips on marking out and identifying high probability mitigation blocks. 1. Coincidence with a fair value gap. If your block coincides with fair value gaps, they tend to be stronger. For instance, if your bearish mitigation block coincides with a bearish fair value gap, you have more confidence that once the price reaches this level, it will more likely reverse back to the downside. 2. Presence of displacement. Displacement is also another vital confluence that adds strength to your mitigation block. If the move that breaks the structure during the creation of your mitigation block happens with a strong displacement, This is usually a sign that the market is showing strength in the direction of the mitigation block. 3. Market structure shift. Not all mitigation blocks cause a market structure shift. However, those that cause market structure shifts are more likely to hold the price as a demand or supply zone in the future. This is because the market structure shift ushers in the birth of a new trend, which corroborates the sentiment of the mitigation block. ICT mitigation block versus ICT breaker block. Mitigation and breaker blocks are both significant in identifying potential trend reversals in forex trading, but they have distinct characteristics that set them apart. A mitigation block forms after a failure swing, which occurs when the market attempts but fails to surpass a previous peak in an uptrend or a previous trough in a downtrend. The pattern indicates a loss of momentum and a potential reversal as the price fails to sustain its previous direction. ICT breaker block is also a reversal pattern and looks almost same to the ICT mitigation block. But the difference between these two is that ICT breaker block is formed after sweeping a high or low in market structure shift, while in mitigation block price does not sweep high or low. In fact, price fails to swing higher or lower and then shifts its structure. In breaker block, you mark last up or down close candle, while in mitigation block, you mark a short-term price rally or decline as your point of interest. On the other hand, a breaker block is characterized by the formation of a new high or low before the market structure is broken, indicating that liquidity has been taken. This means that although the trend initially looked set to continue, it quickly reverses and breaks structure. In effect, a breaker appears when the market takes liquidity beyond a swing point before reversing the trend. A mitigation appears when the price doesn't move beyond the trend's most recent high or low, instead plotting a lower high or higher low before reversing the trend. Mitigation block example. Let's look at the ICT mitigation block example. As you can see in the chart, price was in bullish trend, initially making higher highs and higher lows. But after reaching a bearish PD array, price failed to make a higher high and started declining. After that, price broke previous low and shifted its structure to the downside, resulting in a bearish ICT mitigation block. Then price retraced above to the mitigation block and delivered a beautiful sell setup. Okay, everybody, that was it for this ICT mitigation block episode. See you in the next one.